Today we are focused on capital gains tax treatment for the Series 65 exam. This is a critical area because the exam expects you to understand how investment gains and losses impact a client's tax liability. Let's start with holding periods. The length of time an investor holds an asset determines whether a gain is short-term or long-term. A short-term capital gain occurs on assets held for 1 year or less. These gains are taxed at the investor's ordinary income tax rate, which can be as high as 37%. In contrast, a long-term capital gain applies to assets held for more than 1 year. To be precise, it must be held for 1 year and a day to qualify. Long-term gains receive preferential tax treatment, with rates of 0%, 15%, or 20%, depending on the investor's income level. For the exam, the key takeaway is that long-term gains are more tax-efficient for clients. An exam question might present a scenario where a client has held an appreciated stock for 11 months. The question will ask for the most suitable advice. The correct answer will likely involve advising the client to wait another month and a day to sell, thereby qualifying for the lower long-term capital gains rates. A common trap is a question involving inherited securities. For inherited assets, the holding period is automatically considered long-term, regardless of how long the deceased or the beneficiary actually held it. Now let's discuss the wash sale rule. The exam will test your knowledge of this rule, which prevents investors from claiming a tax loss on a security if they buy the same or a substantially identical security within 30 days before or after the sale. This creates a 61-day window that you must be aware of. For example, if a client sells 100 shares of ABC stock at a loss on June 1st, they cannot buy back ABC stock between May 2nd and July 1st and still claim that loss for tax purposes. If the rule is violated, the loss is disallowed for the current tax year. Instead, the disallowed loss is added to the cost basis of the new replacement shares. This will reduce the taxable gain or increase the loss when the new shares are eventually sold. The holding period of the original security also gets added to the holding period of the new shares. The exam might test this with a question where a client sells a stock for a loss and immediately buys a call option on the same stock. This also triggers the wash sale rule because an option is considered substantially identical. Finally, we need to cover cost basis methods. When an investor sells a portion of a position that was acquired at different times and prices, they must determine the cost basis of the shares sold. The default method for most brokerage firms is first in, first out, or FIFO. This method assumes the first shares purchased are the first ones sold. Since the earliest shares often have the lowest cost basis, FIFO can result in a larger taxable gain. A more tax-efficient method is specific identification, where the investor chooses which specific lots of shares to sell. This allows them to strategically sell the shares with the highest cost basis, thereby minimizing the reported capital gain. For mutual funds, an investor can also use the average cost method, which averages the purchase price of all shares owned. A key exam point is that once an investor elects to use the average cost method for a mutual fund, they must continue to use it for that fund. Here's a mnemonic to remember the wash sale rule window: 30 days before, 30 days after. Don't be a wash sale disaster. This helps reinforce the 61-day period. For free practice questions, AI-powered explanations, and more exam prep tools, visit openexamprep.com. That's openexamprep, all one word, .com.